Hey everyone, this is John Feneck with the Feneck Commodities Report, and with me today is Don Durrett from goldstockdata.com. Don, Happy New Year to you.
Yeah, John, let's do another show.
All right, first one of 2025 for just the two of us, and let's touch briefly on macro today, and then we'll pivot into a topic that I get how gold was up 27% last year and how GDX, the largest mining product out there, was up only 10.17% last year. And a lot of clients are left, wondering what's up with that. So, let's jump into macro first and then we'll tackle that if that's good with you.
Yeah, excellent, for sure.
So what are your thoughts on the macro side here? Obviously, we've got CPI tomorrow. We've got the Fed later this month. We've got Trump on January 20th. A lot going on.
Yeah, so heading into the new year, I've been bullish the stock market because you have the January effect. You have all the 401k money, it automatically comes in. You got a lot of bullishness, up 25% the last 2 years. Everybody thinks everything's going to keep going. You got that normalcy bias going. So my expectation in Q1 is higher highs. So we're 58.37 here. I think we go to 62. I think we get to over 6,000 again. And then once you get over 6,000, I think we're going to hit a new all-time high, which is 6,099. I think it'll keep going. So I'm thinking, this first quarter is going to be climbing this wall of worry and this optimism. And so I think we get to 62, 63, 6,400, and then the exhaustion kind of kicks in. So the earnings expectation for 2025 is actually 14%. That's a high hurdle. It's going to be hard for these companies to hit these earnings. And the other one is 6,300 is what they expect. And I expect to get there in Q1. So once you get to 6,300, you're maxed out. And then it's like, can we hold this? And that's where I think the exhaustion kicks in. So I turn really bearish. Like once we get to March, I start turning really bearish the stock market. We'll see how it all unfolds. But January, February, I'm bullish because so much sentiment, so much positive sentiment on Wall Street and Trump. There's, Trump, everybody expects Trump to be pro-business. They expect him to do positive things. So I think that's going to happen. Now, in the backdrop of that, there's a lot of problems. First of all, you have the DXY at 109. Nobody expected it to run that fast from when Trump got in. It just ripped up to 109. And the reason why is because the bonds are up over 100 basis points from when Powell lowered rates in September. It was 3.7 in September, and now it's 4.8. And everybody thinks it's going to go to 5. And 4.85 is kind of headwinds for the stock market. So I think the stock market is going to be able to fight through these problems. But how does Trump get that DXY down? And how does he get the interest rates lower? It's going to be really hard in the near term because he's not going to be able to get Powell to cut rates aggressively. Powell's like, I'll do a quarter point. That's about it. All you're getting, Trump, in the first half. And then the only other way you get the dollar to go down is a crash, stock market crash. There's a third way. You could print a lot of money. Well, that's not going to happen. You're already printing $2 trillion. And the Republicans who control both houses, they're not going to, let's print 2.5 trillion. That's not happening. So the way to get the dollar down isn't really in the cards here in the near term. So that's headwinds for the stock markets. That's where that exhaustion kicks in. I'll let you make a few points, and then I can talk a little bit more about more headwinds.
Okay. Yeah. No, I understand what you're saying there. I don't know that I'm as bullish on the broad market in January, February, and the reason why is the action in December was quietly not good in a lot of the large caps. Like if you look at the Dow DIA as an ETF, it really struggled in December. It had its worst 11-day stretch since 1974. And I think that you could see some, January effect here, but I actually just shorted the Russell because the Russell was only up 11.5 last year. And again, that's just not a good performance when other indices, that are, much more compact or doubling, your return return and then some. I think the Russell will lead us down, and so I'm watching it very closely because that did lead us down in other corrections, recent history, last 20 years, almost every time. So that's IWM for you, for those of you that want to follow the big ETF out there. But we just started a short position. I'm probably early, but I think that and international in general are in trouble. Like emerging is starting to show signs of weakness. China is starting to show signs of weakness. I think you could see, like you said, maybe a test of that 60.99 and maybe a little higher, but not much. I really think it'll look like a double top on the chart.
Right. Well, it won't take much. 5% take it to 6,300. So
right.
That's not much of
yeah,
a move.
I feel like it'll just depend on how aggressive Trump is right out of the gate, right? Like I think euphoria could turn into, not fear, but definitely more caution from investors if it's a little bit too much all at once, which that's sort of his style. It's sort of like, just let's go with everything at once. And I think he's been waiting for this for like, how many months upon months upon months to have the microphone, right? Like, so I don't know. I feel like there's some possibilities that the BlackRock, Fidelity, I don't know. There's a lot of active managers out there that are bonused on beating the S&P, right? And they have to do that, and they have to do that year in and year out, or they don't get bonused. So how do you do that in previous years? Well, you take a lot more risk than you're used to taking, meaning overweighting tech in core portfolios or value portfolios even, because you've got to keep up and show some type of outperformance above what you're benching against. So I think that that's going to come to a bad end this year at some point. I don't disagree that it might not be right away, but I think that it could come in a more aggressive fashion than people are used to, because you and I were participants in the market in 08, 09. We saw what happened to Washington Mutual and Citi and a lot of these companies that were overweighted then. It did not end well.
Right. For me, it's all about seasonality. You just generally don't get crashes in January. It's pretty rare. And then usually, you get through January and then February. February for me is another positive seasonality month. It's like you generally don't get crashes in February either. They usually come in March or April. For me, it's all about seasonality here and bullishness and sentiment. But if we look at, I hear where you're coming from about, it does feel like kind of a 1987 type of situation here where the market is just way overvalued and needs to crash, if you will. I mean, so you have this huge earnings growth that they need to hit 14%, which, I mean, good luck. I don't think they can hit it. Then you have housing. Housing is a train wreck right now. You have mortgage originations are all the way back to 1992 levels. Nobody's buying houses right now. Autos is also a train wreck. I mean, if you're a real estate agent or you're a car salesman, you go to work every day, you're not happy. You're like, I hope I can sell something. Probably won't. And then retail, if you own a retail business or a restaurant, there's a good chance you're not sleeping well. You're like, can I keep my doors open? These industries are all at recessionary levels. They keep saying that the economy is strong on Wall Street. It's unbelievable how the spin right now coming out of Wall Street. If you turn on, any of these business news channels and listen to some of these analysts, the spin is unbelievably bullish. I'm like, they're just cherry picking the positive data. They're ignoring what I just mentioned. The other one that they're ignoring is the banks. The banks are, flat yield curves is bad for the banks, and we have flat yield curve right now. You have delinquencies that are on the rise. You have bankruptcies on the rise, and then commercial real estate. They've been pushed that into the future a ways, but at a certain point, that starts to bite them. And then they have all those bonds that are underwater, which isn't cleaning itself up because the rates are staying high and those bonds are staying underwater. Some of these really big sectors are hurting. But you have, you have technology, you have healthcare, and you have government. Those three are keeping the economy above water. But it's a tale of two cities. they're doing okay because of the government stimulus. And I say stimulus, I'm talking about deficit spending. Yeah, basically it's $2 trillion of stimulus. That's what it is. I mean, talking about the truth. We're borrowing $2 trillion and throwing it into the economy and counting it as GDP. So we're printing GDP. We've been doing this. We've been manipulating the economy since 2007, 2008, say. Manipulating the economy just ruthlessly. And you're right. This thing could blow up at any minute.
Yeah, well, let's just count months and years, right? March of '09 to now is almost 16 years. It's just never happened in recent history where you have a 16-year run of this magnitude. So it just seems logical to me that you're going to get someone's going to blink. And I'm telling you, the technology thing it looks like financials in '08, '09 to me. It's like there's a lot of money flowing into the same names. And when that money starts flowing out in a meaningful way, it will cause a wave of selling. And people are going to wake up and look at something like the S&P in their 401k and say, wow, how did this thing lose 12%? This is like a third of my entire net worth in my 401k. It's not unusual for people to have a third or a quarter of their money in the S&P because you know what happens, Don? I mean, this is my old job, right? I used to work where, let's say, ABC Financial would win the 401k at IBM. So they go and visit IBM once a year, not like quarterly like you're supposed to, and really talk to employees once a year. And you sit down with these employees and you say, hey, Mr. Jones, you're up another 25% last year. Congratulations. They don't even like look, as to how they're generating that return. It's literally overweighting stuff that a 65-year-old or a 60-year-old should not be in. They should be in more conservative stuff, and they're not. They're heavy, heavy equities. I mean, I see stuff all the time, and I'm just shocked that these people don't understand that the S&P return is being generated by a handful of names. And if you omit those names, it really doesn't look that good. So that's what I'm trying to warn people about the last 2-3 months is please, take a minute on a weekend to look at this stuff and sit with your financial advisor and ask difficult questions. Like, how are we going to do, this kind of return in 2025, Mr. Advisor? Like, what's the game plan here? I guarantee you most people don't have a game plan. They just put clients into glide path type product. That's just what's happening.
I really think that we are hitting a Japanese moment. So right now, what's happening in the U.S. is you had foreign money flood into the U.S. stock market. And the reason why it's flooded in is because we're the only stock market that's been doing well. And so historically, the U.S. stock market should be about 40% of global, because we're 25% of GDP. We should be about 40% valuation at the most for our stock market, but we're currently over 60%. Some might say as high as 65. And that's a recent phenomenon because basically since around 2016, we've been the only stock market that's been kicking butt. And so all this foreign money has been flowing in. Well, the same thing happened in Japan in the 80s. Japan's stock market was kicking butt, and their equities, their companies were all doing well, and you had all this foreign money flooding into Japan. And their stock market was at 47,000, and then it just crashed in 1989. And it stayed down for 20 years. And so the same thing could happen to us. We could go down and stay down for a long time and yours can be underwater. But I want to talk about what I think is the most important factors going into this year. And that is Trump versus Powell.
Yes.
And what they have, and what they both can do to help the economy. So we can start with Trump. So Trump, he wants to keep the economy going. So he's going to basically he wants to do cuts, but the problem is he can't really cut low. The tax rates are already low. You got 15% capital gains. You can't cut it more. You got corporate rate at 21%, I think. You can't cut those. They're like bare bones. The only thing he can really do is cut like the middle class. He can drop the number of people that don't pay tax, because those are people that are broke. Those people can't pay their bills. He could possibly do a cut on the bottom end, but he can't do it much anywhere else. But the irony is, those aren't his peeps. The lower end is not his peeps. The upper end is his peeps. So is he going to really cut the lower end? So, and then he's going to do tariffs to generate some revenue, but that's actually negative because that creates inflation. And he wants to talk down the dollar, but now we got to go over to Powell. So Trump really can't really do anything about the dollar, but talk it down. Good luck with that. He doesn't have any policies now, and so he's got this. But now he's at loggerheads with Powell because Powell wants to continue to fight inflation because he knows that unless he gets inflation under control, things could really get bad. And he wants his tools back. Now, what are the tools that historically the Fed has used? If we go back to 2007, the tools were he could lower rates to zero, which he can't do. That's the tool number one, the ability to lower rates. And the other is to inject money. Right? And we go back to 2008, 9, he was injecting money at will. Well, guess what? He can't inject money either. They call it QE, right? So Powell, he's in a reactionary mode. No, he's no longer proactive because what he wants to do, he can't do. So he's reacting. He's trying to figure out. He's basically juggling all these balls in the air, and simultaneous to that, Trump is going to be screaming at him, cut rates, cut rates. Forget about inflation, cut rates, cut rates. So this is a very and when Trump creates an enemy, he can't help himself, right? Middle of the night, he's tweeting, and after Powell. I guarantee there's going to be at least 20 tweets against asking Powell to cut rates or the Fed. He won't say Powell, he'll say the Fed, of course, but he'll be insinuating Powell. So this year, the first half of this year, and going all the way to the rest of the year, you're going to have this big fight between those two guys, and neither of them. I really don't think either of them can resolve their problems. So that's why I think in Q2, everything's going to basically blow up.
Mm-hmm. Yeah, I agree with the thesis that Trump and Powell will be locked up in a battle. And I just don't know that it's going to take until Q2. That's where we're a little bit different because I think it's going to be shocking to people. You and I do this for a living, right? We look at this stuff every day. But most people don't, and they're going to be shocked. There's a lot of people with fake money out there, real estate money, right? Money on paper that have made themselves wealthy through, good, smart decisions on buying cheap real estate. Well, guess what? The real estate market is in trouble right now because it is not going to just continue to move higher 20 to 25% per year in rural or, different types of markets in the U.S. It's just going to be a really difficult time over the next couple of years because real estate is cyclical, and that's what some people tend to forget. But if you talk to people that lived through the 80s and actually had money at risk, they remember they got their hand slapped, right? Like that was painful. And it took years and years to get back. The one that I lived on was I moved here to Arizona in 2009, and people were like almost begging for me to buy their house. By 2010, when I waited it out another year, I did have people begging me to buy their house. Now, this is a really nice place, right? Like we live close together and there's a lot of cool stuff around here now. Back then, it was a different market. It was an overbought market. That's the market I think we're living in right now. Like there's so many cities you could point to and say, man, there's so many cranes as I drive through these cities and stuff. Like there's going to be a lot of people holding real estate when the music stops and there's nowhere to sit, so to speak. And that's going to be another problem, right? Because what drives the stock market or Bitcoin purchases? I think real estate. I mean, real estate is intertwined with the market. If you're feeling good about your market returns, which a lot of people are the last 24 months, they'll take risk in the real estate market. But to your point, now mortgages are super high, and it's just go ahead. I know you want to say something.
Yeah, I wanted to pivot into gold and how the miners have not performed versus the
sure. We talked about that off camera. So absolutely.
Right, before I start on that, I just want to mention you're absolutely right about real estate. So we have stocks as far as asset wealth. We have stocks, bonds, and real estate. Those three have done extremely well over the last 10 years. And so they've created a wealth effect. And I think the wealth effect is one of the reasons why I think we might get this last rally here. But that wealth effect, people are going to get rug pulled. I think it's going to be, depending on which city you live in, real estate is going to be like 10 to 30%. And in the stock market, I think is going to be 30 to 50%. And in bonds, maybe 20%, somewhere in there. But they're all going to get rug pulled severely. So now we go back to gold. So one of the things that I've noticed is that the gold miners have actually gotten very healthy. And I've been mentioning this as far as if you look at their free cash flow multiples, they're trading about 50% below where they really should trade. They just haven't caught up. But simultaneous to that, their balance sheets keep getting better. So the average margin right now is around $700, $800 margins, which is very healthy. These companies are generating a lot of free cash flow, and they're not getting rewarded. I was looking at B2 Gold today. They lowered their dividend and they got battered because nobody cares about the future. They're like, I want my dividend this year. I'm not getting a dividend this year. I'm out of here. But B2 Gold, I mean, they raised their ASIC to 1,500, so that gives them about 1,800. That's about $800 margins. Well, they're going to generate 1,000,000 ounces. That's $800 million in free cash flow. Or is it, 1,000,000 ounces at 800 million. I mean, that is a lot of free cash flow. So they're trading at a 4 multiple right now, 3.2 billion. But a 4 multiple for a company that has that kind of margin and that is a lot of free cash flow. A company of that size, and they're at 4 multiple, but they're not that unusual. Last time I looked at Newmont, they were trading at a 9 multiple, and they're like one of the leaders. I mean, absolutely a leader, right? A 9 multiple, they should be trading at least 15. A company like Newmont, but their margins aren't quite as good. Their margins are about 7. But they mined 6.5 million ounces of gold. I mean, that's a lot of free cash flow, but they're not getting rewarded. And so my point is that these companies' balance sheets are all getting better. So we've had like 6 months of a lot of free cash flow. I mean, if you try to find right now today, if you try to find a company that has a debt problem that basically is heading to possible bankruptcy, it's hard to find one. There's about 130 gold producers out there, 130, 135. If you go down that list and you try to find gold miners, not so just gold miners, you try to find ones that are basically having problems, trouble, they're hard to find. Most of them are doing well, but they're not getting rewarded. But my point is they have tons of leverage, tons of leverage.
Yep.
These stocks will double quickly, and they will. They will double quickly once gold gets to, let's say, 3,000. I think 3,000 is a round number. You get to $3,000 gold, and just about every gold miner is going to double, and some of them are going to triple in value at 3,000. And the sentiment is going to just flip. It's just going to flip, and that's when GDX will outperform gold. Like right now, it's underperforming gold significantly. You get above $3,000 gold, they're going to start outperforming gold, and that's the norm. And these miners are just going to rip faces off, and nobody wants to buy them now. And like Buffett said, that's when you want to buy. You want to buy when nobody's buying.
They all want to see breakouts before they buy, and you're going to leave 20% on the table, maybe more. And that's why we're buying pretty heavily since December. We were net sellers most of September and all of October leading up to the election. We then let things kind of settle in November and started to get more aggressive, like in late November buying. We bought through December. I don't know if I sold anything really of significance in December. And then we're selling a little bit in January here into some rallies, as you've seen. But we're going to be net buyers in Q1 again, because I think, like, you're right. I mean, a lot of these stocks won't be at these low prices forever, and you just have to hold your nose and buy at some point. And so, we've spent more time in the explorers and developers last year than any other year in our 9-year history, because they have been so crushed. You and I have talked about a few of them, right? So 1911 Gold comes to mind. We had Sean on 3-4 months ago. They just raised $7.8 million since we had them on in December, and not bad for a 10-cent stock, right? Like, to raise that kind of money. And again, their market cap was about $1 billion 2011, 2012 rally, they're trading at under 20 million now, in a market cap. And so again, if it doesn't go back to a billion, who cares? You've pointed out, and I've pointed out, it could get to 60 million. It could get to 100 million. You're going to make so much money. That's a huge return on your money today at 10 cents, and that's where people are missing the boat, is that they keep, lamenting about holdings that haven't worked. You have to think more positively, I think, now as an investor, because we have our wind at our backs for the first time in a long time last year and this year when it comes to gold price. And that will flip sentiment at some point. To your point about, I'll just mention one other name because I just been doing some digging. One of the interesting dynamics, Don, was when Agnico and Kirkland did that deal. Remember, they both had a ton of projects. Like, they were both invested in roughly 40 different projects. I've heard from a really source close to Agnico. So what they're in the process of doing now is sort of sorting through those 80 plus projects and saying, what do we want to move forward on, and what do we want to give up, right? And there's actually some, consolidation that I think will come of that. First Nordic Metals is one that I think, is interesting because they have a JV with Agnico, but they have a senior management team that wants to really advance that project. They just raised, when 1911 was raising almost 8 million, they raised 11.5 million at the same week. They did it, to where the share structure is still intact, right? But they then came out with a press release in mid-December and said, we're going to have a big drilling season. So I think you could take a project there that goes from 3 million ounces to 4 or 5 million ounces. And in a hot gold market, that's going to be worth a lot more to people. So we're trying to position with companies that have big ounces in the ground, whether it is gold or silver, thinking that we're going to get to that 3,000, an ounce magic number this year.
Yeah, I'll mention a few names. I definitely agree with you in 1911. I've always liked that stock. They seem to be heading in a good direction. It looks really, really solid. Another one along the same lines of 1911 is West Red Lake Gold, who's going to start producing next year. And they're being very careful. They're making sure that their head grade is really strong. They're going to start at the highest grade area. And I think that's going to get them off to a good start. And I like the property. I think, once they get going, I think they're going to be able to expand production. So I'm big on that one. Free Gold Ventures today came out with step out holes in the south and the southwest. So Free Gold Ventures has 30 million ounces. It's basically one pit. And this is expanding the pit further south and further south. I think it's going to get to 35 million. So if it's ounces, so if they sell for $100 an ounce, that's 3.5 billion, and they're currently under 300 million. So for me, that one looks really juicy. And then today, Gatos voted yes for the First Majestic, and a lot of people thought, these votes usually always go yes if the board proves it. But basically, there was no legal battle, nothing to hold it up. Thank goodness. I think that this should close. They should close this deal, I think, now. I was expecting the vote in December or January, so this should close in February, I would think. That's a game changer for First Majestic, literally. It fixes First Majestic's free cash flow problem. First Majestic had a high cost issue, and now this is going to generate plenty of free cash flow. They're going to be a 32 million ounce silver equivalent producer with, an AISC probably right around 20, maybe a little low, 19 or 20, maybe 21. But any of those numbers work. Basically, First Majestic's healthy, and their stock price doesn't represent that. So I like that one a lot.
What do you think about CDE? Because that's a very similar situation to the one you're just talking about, right? You're talking about First Majestic and Gatos, but core CDE is buying Silvercrest, SILB. And I think that will be very accretive to them, don't you?
Yeah, I don't mention Heckler or Core because if you don't own those, you don't know what you're doing, in my opinion. Those are must-own stocks. Those are go-to stocks. If silver rips from 35 to 50, what's Wall Street going to buy? The first two stocks are going to buy
the mid-tier silver stocks, like those.
They're going to buy Core and Heckler. If you don't own those, it makes zero sense. You're going to regret the heck out of it if you don't own them. Every day you walk up and they're up $2 a stock, a share. So those are no-brainers in my opinion. So I don't need to mention them. Heliostar, they just came out with news today. They did scoping studies on La Colorada and San Antonio. And so, they got these projects just dropped in their lap from Argonaut. So Argonaut said, here, have
Yes.
them for like 10 million bucks. And now they're scoping them out and they want to put them in production. Now, San Antonio, they might not be able to permit it. But if they ever do permit it, you're getting it for free. So it was $135 million capex, and it's a 1.5 million deposit. The scoping study covered 1.1 million. So that's like 80,000 ounces a year kept for 135 capex. You don't see 135 capex anymore. They're all, 135, that's cheap. But
Yes.
it's in Mexico, it's a Mexican build. But if they get that thing permitted, that project alone is worth 5x their current market cap. And they literally got San Antonio for free, literally, and we're getting it for free. So if that thing gets, just the optionality on San Antonio alone, but they have all these other things they have going on: Ana Paula, La Colorada, then they have San Augustine. So yeah, I like Heliostar a lot. I think that one absolutely works. And then a couple more. Vino Silver. I think if this thing doesn't get taken out, this thing is it is one of the cheaper ones because you're paying like 25 cents an ounce in the ground for a mid-tier producer. It's just ridiculous. They have 350 million ounces of silver equivalent. Well, a lot of that's going to get produced. So you have this huge growth profile into the future. I think Hecla should buy a Vino. Coeur gave up on them. Coeur gave them the La Parrilla mine and just gave it here. Well, they didn't give it to them, but they sold their shares. They basically gave it away. I think Hecla should
I
come over.
remember that. That's when we were buying the stock
Yeah,
initially because the stock was getting killed. And you and I had
yeah,
talked about it, and it had a really nice run last year at one point. I think it's going to get back to that level.
yeah. Hecla needs to buy a project in Mexico. They don't have one. So I think Avino for
Right.
me, I think Avino absolutely makes sense because of the growth. They can build it out really quickly. They can basically get Avino's projects to 6, 7, 8 million ounces a year. That's a nice chunk, for a very low cost right now. Then they should buy either, if they don't buy Avino, they should buy Endeavor Silver or Go Gold or Discovery. One of those four they should definitely buy, whichever one they can get a deal on. But Hecla needs to do a deal. They've been trying to build these mines in Montana forever, and they can't. They can't get them. They can't move them forward.
Right.
Then the last one I'll mention is Silver Tiger. Silver Tiger is getting no love, very cheap. And if as soon as somebody gets an open pit mine, now they haven't given an open pit permit in Mexico in 6 years. It's been a long time. So once AMLO got in there, he didn't give any open pits. So if they give out an open pit permit this year, you can guarantee that Silver Tiger will be one of them because Silver Tiger is in Sonora, the northern part of Mexico, which is the best place to mine in Mexico. It's basically a mining district. Nobody lives there. It's just mining, and the people up there want mines. Everybody's pro mining. So you can guarantee Sonora. They're going to get one. The other one's going to get one is Sonora Gold. They're in Sonora as well. Sonora Gold. They're in Sonora.
Right.
They're going to get a permit too. Both of them are going to get permits. So as soon as you see one permit, but both those, I guess I can mention Sonora as well. Those two companies. Now, Silver Tiger is actually open pit and underground. The open pit is gold, but they want to mine that one first because it's the cheapest. It's easy to mine. Then they want to go to do the underground silver. So yeah, it looks really juicy once they get their permit. And nobody wants to buy it because everybody's paranoid they're not going to get the permit.
Right.
But
Yeah.
I gotta
That's true
believe.
of a lot of the silver plays and gold plays in Mexico that are open pit right now, right? Even post Scheinbaum getting in October 1st, there's still a lot of skepticism. You and I interviewed Sonora Gold, SMOFF, and we were both impressed with how they're approaching this. And they've kept very close ties to the Mexican government. As far as areas of Mexico go, the Sonora state is in a really good shape for those of you that aren't geography majors, which I am not either. it is on the Arizona border pretty much, so it's like not far from the U.S. And that state seems to be in line with getting open pit, permitting sooner than other parts of Mexico, which is one of the reasons that Don and I, have talked about a stock like that. Another one that I just found, Don, that is completely flying under the radar just through research this weekend was Quest Corp. It's QQCMF in the States, QQQ in Canada. This has the La Union asset, which is permitted already, and the stock is trading at like 4 cents US, 6.5 Canadian. It is just like I couldn't believe when I saw that because
What
there's so
company?
much press. It's called Quest Corp.
I haven't even heard of that one, Quest Corp.
Yeah, I don't know if it's even in your database, but
Is it gold?
yeah, it's gold and copper.
Okay, I'll check it out.
Yeah, but basically it's an interesting one because it's just flying under the radar. If you start getting that news flow of, hey, we've got our open pit mining permits, I mean, these guys are going to start waving their actual permit and saying, yeah, buy us. I mean, that's an easy way for a larger company to get access to Mexico, I think, quickly. So you got it done. Well, thanks everyone for joining us. You'll have my contact info in the last slide here if you want to contact us. I'll be hosting conferences in May twice, May 11th through the 13th at Fort Lauderdale, Four Seasons. We did that last year, had a great time. Our website is topshelf-partners.com if you wanted to see the statistics around that event. And then also we're going to be doing Georgia for the first time, Atlanta, Georgia, May 14 through the 16th, with a whole nother set of companies and clients a little north of us, about an hour flight north of the Florida conference. So we hope to see you on the road. And if not, send us an email. Be happy to answer it. Thanks for your time.